This video, I want to talk about how, dividend reinvestment plan works. When it comes to dividend reinvestment plan, it has to do with reinvesting your dividend automatically into buying uh, more units of the stocks you are invested in instead of the dividend being paid out in cash to you. The dividend is automatically reinvested into the investment class you are currently invested in. And this approach allow investors to compound their returns over time instead of kind of spending your dividends. You are reinvesting it, and it helps you to compound your investments over an extended period. And so what essentially are the key concepts of dividends reinvestment strategy or dividend reinvestment plan? I want to talk about number one, the definition and the purpose of this particular plan. A dividend reinvestment plan actually, is a program offered by companies or investment funds that allows investors to automatically reinvest their dividends to buy more shares of the stocks that had given them the dividends in the first place. And by so doing, you tend to accumulate more units of the shares you've invested in. And whenever the investment appreciates, you tend to have you make more money than simply using your dividends to meet your to meet your obligations. And of course, it doesn't really attract fees compared to you just buying stocks on a normal basis. And so the objective here is to maximize investment growth over time by using your dividends to acquire more share of the company, so you benefit from the compound growth that arises as a result of this particular strategy. It will then, at the end of the day, it will maximize your total returns. Number two, how does it really work? It has to do with automatic reinvestments. When a dividend is paid, usually it is instead of receiving it in cash, the amount is automatically channeled into purchasing an additional units of the stocks you've invested in. And not only that, there's that particular compounding returns. By reinvesting your dividends, you have that advantage of compounding your returns over time. And there's that particular advantage of having a higher return, a better return, compared to you not adopting this particular plan. And so you purchase at a market price. Shares bought through dividend reinvestment plans are typically purchased at the current market plan. Though some plans offer shares at a discount to the market price. If you are able to get that particular advantage, I think to be of real benefit. You'll be able to buy shares at a discount, as the case may be. Number three is the benefits, the advantages of dividend reinvestment plans. Number one is compounding growth. So reinvesting dividends accelerates the growth of the investment through the power of compounding. Someone said that compound interest is the eight wonders of the world. I think it's correct. So number two is there's no transaction fees. Many dividend investment plans allows investors to purchase additional shares without paying commission, without attracting fees, which invariably reduces the cost of reinvesting your fund. So you may equally benefit from discounted shares. Some plans could offer you shares at a discount, enhancing the values of your portfolios at the end of the day. It equally have incorporate dollar cost averaging. Regular reinvestment of dividends help you to inculcate a kind of dollar cost averaging into your investment process. And this will go a long way in reducing the impact of market volatility on your portfolio. I want to highlight the drawback, the disadvantages, the pitfalls that comes with dividend reinvestment plan. A prominent aspect of this is lack of flexibility. Reinvested dividends are used to buy additional shares in the same investments, which might not allow you to have the leeway of investing in other investments or other company. It must be in the same company that issue the dividends. So in this case, there's no flexibility. You are bound to buy the same shares regardless of market conditions. You equally have concentration risk in the sense that you keep on investing in the same company that gives you the dividends. You are invariably concentrating your shares in a single company, as the case may be. So that concentration risk will always arise as a typical disadvantage of the dividend reinvestment plan. The other one is tax implication. Dividend reinvestment plan, are still subject to income, tax, and investors need to keep track of the reinvested amount for tax, reporting purpose. So the tax is still there, and you have to be very careful to record the amount you invested for the purpose of giving, your accurate tax returns. So how do we enroll in a dividend reinvestment plan? How do you key into this particular plan? Number one is that you have to check eligibility. You have to verify if the company or fund, allows you to reinvest your dividend or offers this particular strategy. Not all company or funds provides this option. So you need to check the eligibility, the availability of this particular plan. Number two is you enroll in the plan. After checking and then of course the eligibility is there, is available, you will need to enroll in the plan. So many companies or funds allow investors to enroll in the dividend reinvestment plan through their website, through their shareholder services, or through your brokerage account. Through your broker, you could enroll in this plan. Not only that, number three, you set up automatic reinvestment. That's very important because everything here, tends to be done automatically. So you choose to have your dividend automatically reinvested rather than receive, in cash. Some plans may offer additional options such as purchasing shares at a discount. Some options will guarantee that the shares you buy, you do that at a discount. You buy below market price. Not only that, number four, you monitor your investments. There's always the need to rebalance. You monitor your investment, and if the need arises, you rebalance your portfolio. You sell what is not doing very well, and you buy more of what is performing very well. And by so doing, you are able to easily meet your investment objective, the goals you set for yourself as an investor. So what is who in particular is this strategy meant for? Usually it is for long-term investors, for those who have a long-term horizon, for those who want to inculcate a kind of buy and hold strategy into their investment mix. It is for income investors, investors who receive dividends from stocks or funds and want to reinvest them to increase their investment exposure. If you're the type that likes income, as the income comes in, instead of spending it or using it to foot your bills, you automatically channel it into your investment to enhance growth in the portfolio. It's equally good for retirement savers, individuals who are saving for retirement. They have this long-term horizon, may want to enhance their portfolio by inculcating or introducing dividend investment plan into their investment strategies. This will, at the end of the day, guarantee, a more comfortable retirement, at the end of the entire process, because of the compounding involved, because of the higher return involved. Then you will end up retiring, uh, probably early, but more importantly, you retire comfortably.